Hi, I'm Bill Baruch, president of Line Captial, and I'm here with their analyst, Jannis Meindl, and it's the Triple Play podcast. We got a special one here for you today covering the auto industry and a lot of data. We're going to take a look at the Nonfarm Payroll report that just came out last week, and we have CPI today. So, Jannis, why don't you start us off with the macro and dive in?
Yeah, thanks, Bill. So we'll start it off with what we got last Friday, which was non-farm payrolls coming in strong again, although off of the earlier levels we saw this year at 236,000 jobs. But overall, from average hourly earnings to the wage gains themselves, these are not recessionary numbers at the moment. Just looking back over the course of history here and the kind of job expansions we saw all along, we are really still above the averages and median job expansions that we saw during those points in time. And then if we look on the more subsector level, we do see some encouraging signs, especially as construction is not seeing those excessive job gains anymore. We do know that from PPI data that construction actually has been a place where there was still extremely elevated inflation. So there's some encouraging signs there. And if we look at the percentage of sectors that indicate an increase in employment versus the percentage of sectors that report a decrease in employment, that number is also leveling off, although it ticked up slightly here last Friday. But overall, it just shows us that things are renormalizing in the grand scheme of things. And then I would just highlight that with average hourly earnings and sort of the concern that we have had ever since the inflation really ticked up, it's been this wage price spiral conversation a lot of people have been having. But if we extrapolate the data that we've gotten recently, we will be on track towards that 3% mark by year end. And what does that mean? You have 2% inflation, you have 1% of productivity gains, and that gets us right to that 3% mark. So that is also in line with the Fed's inflation target. Bill, that's it for non-farm payrolls. I'll kick it back to you on inflation.
Yeah, we had the CPI report today. It came in on the softer side, but overall, this was in line with expectations. We even heard comments from some of the Fed members, Daly and Richmond Fed, from the San Francisco Fed, as well as Barkett from the Richmond Fed. We also had the Fed minutes today, but the theme really is there's more work to do, and we haven't seen a shift from the Fed on what their narrative is, and so. This is just in line with expectations. We saw a volatile reaction from the markets. The key takeaway, again, is we have headline inflation at the lowest level since, I think, May of 2021. Month over month, that's the year over year number at the lowest since May 2021. The month over month, only an increase of 1/10. And that's definitely a slower rise in inflation. And the market reacted favorably from that. Some of the components, you look at shelter and you look at services, and these numbers are below the 3-month trend, the 6-month trend, and of course the 12-month trend. They're trending lower, and these were the real concerns. And furthermore, services ex rent was actually disinflationary by 3 basis points. So there's really some positives here. But the fact that the Fed hasn't shifted their narrative may be the reason why the market's not digesting it very well, because it was simply in line. Let's not forget either that we had this massive run up at the end of quarter 1, a lot of window dressing, chasing in tech, and the market hasn't done anything wrong. And I talk about that daily in my videos. The market hasn't done anything wrong, but we're consolidating and digesting these gains overall. And this report, just in line, kind of moves moves the sticks down the field here. It gets us closer to that May 3rd Fed meeting. So it'll be interesting to see. Let's dive in here. We're covering the auto industry today with Ford and then GM and then Tesla finishing out there. So, Jannis, why don't you start us off with an overview of the auto industry before we dive into the individual names?
Sounds good. So to level set the conversation here and the sector dynamics we're talking about with all of these names here today. So looking at global vehicle sales, they have decreased substantially from 85 million vehicles sold in 2017 to 65 million vehicles run rate here per year, which just shows the trend that car ownership and the trend towards car ownership is decreasing. You see it with a lot of the ride-hailing services, a lot of the macro trends that are not really encouraging more vehicle sales in the aggregate. We will see if that holds true not only here in the developed countries, but also in the developed world. About 23 million of those sales are in China. So we will see, and also the amount of competition that U.S. car makers will face from not only the traditional manufacturers over in Europe, but also Chinese manufacturers like BYD and Geely, who have really taken up their game here. And then if we just look at global EV sales, the market share of EV sales, globally speaking, has ticked up from 9% in 2021 to 14% in 2022. And that's the ultimate reason why a lot of the traditional internal combustion engine car makers have shifted their focus from producing more and more ICEs to producing those EVs and really putting a lot of investment towards that. We will cover some of the more micro data points here and what does that mean for all the car makers combined in the stock specific section. Then another dynamic that we've seen is the tremendous rise in used car prices here ever since the COVID time sort of began. And what has that meant? That basically people have purchased used cars at extremely elevated prices. And these prices are ultimately, although we have seen a little bit of a tick up in prices again recently, those prices are expected to come in. What does that mean? People will have to service auto loans off of a much higher base. And that means that ultimately, maybe as the consumer weakens just a little bit, although in the grand scheme of things, looking at real disposable income and such, the consumer is still quite healthy. But if you're just working off of that much of a higher base, that means that probably delinquency rates, and you see it with the transition into 30-day plus auto delinquency rates, which are rising at the moment, those will probably tick up, and that will not encourage those new car sales because people who are already servicing those higher car prices are not encouraged to do that. If we look broadly at the industry, we see really that the only brand that's profited off of this move into the EV sector as of recently is Tesla, while all the other companies are really still heavily investing in this space. And we see that with Tesla car sales increasing drastically here over the recent years, while GM's auto sales have fallen off of 10 million units. I think right now they're closer to 6. And with Ford, you see a similar trend that's fallen off of 6 million to closer to 4 or 5 million cars a year. So these are the trends on a macro level for the auto industry. Bill, I'll hand it back to you and we'll kick it off with Ford here.
Yeah, that's great. Some of those points you touched on. I mean, just the real takeaway. I mean, this is a very cyclical industry. Talking about some of the delinquency rates that could be ticking up here within the recessionary conditions. We don't own any of these automakers right now. We have owned Ford at specific times where we felt there was a potential move and a potential value play after selling off, but we're very cautious in this space right now. But it is a great space to understand better. That's why we're covering it for you and kind of just updating our notes as well and everything. And as always, there's terrific chart book here. So dive into the chart book on your own time as well, and kind of just take a look at the data that Jannis had spearheaded here and combine and putting together. So Ford, we're going to start off with Ford. Now, this was a negative multiple trailing, negative 25. We now have the next 12 months multiple at 7.6. Free cash flow is continued to dissipate. I mean, they got a 0.4 free cash flow yield. That's down from 2.2% in 2019. And you know what? A lot of this is just the expenses, the CapEx that has continued to in order to get break into this space. But when you look back at 2021, there was this sort of elevated hockey stick move. I mean, a lot of stocks had that, of course, but specifically looking at Ford and GM, and you'll see the charts. In order to do that, they played the game. GM and Ford played the game that Tesla had really created. Create these lofty expectations. You're not necessarily hitting them right away. You hope to hit them down the road, and people kind of start understanding that. So what we've seen really is a theme of lowering revenue expectations now, EPS expectations. I mean, for instance, Ford's revenue estimates, they got slashed from 165 billion in 2022 to 153 billion today. 2024 estimates topped out at 171 billion in 2022, and they're down to 156 billion. We've seen, I mean, essentially you're getting like 10% cuts in revenue, and the thing is, it's not really that's not the recessionary conditions doing that. Those are the lofty expectations that were planted in 2021 that are now really coming in. And I mean, just because they can't meet those expectations, operating margins, for Ford have stagnated around what 4%. And you pointed to Tesla; they're the only ones really been able to have some success here. Their operating margins have expanded, but when you're fighting against, you're fighting an uphill trend as Ford and GM with higher. Falling operating margins relative to Tesla, which is continues to increase. That's going to become a continued headwind going forward. And the F-150, the F-150 customers, more than 60% of them are new Ford customers. That is a positive takeaway. The EV push has expanded the network of customers. So those are positives. I mean, it's not all negatives here, but we're just very cautious within the space right now. Jannis, what do you have for us on Ford you want to touch on?
Yeah, I think this is a really good point you made with Ford and GM and a lot of the auto manufacturers who started playing that game of setting lofty goals that are really hard to meet. You have to remember that as those revenue expectations decline and as the CapEx estimates are not declining with that, you will see a substantial margin compression. The game that they're playing right now, and that's really concerning investors, is you see a subsidization in essence, where you have the pickup trucks, which are still the profit centers of all the U.S. car manufacturers. So in case you're not selling those, you're not going to be able to fund your initiatives on the EV side. As vehicle sales, as we pointed to in the introduction, have declined, they will see margin compression. They will see net income declining, and it will make it harder for creditors to extend the funding that a lot of these companies need in order to engage and ultimately accomplish their lofty goals on the EV side. I think at the end of this year, Ford set a goal of producing 600,000 EVs by 2026, producing 2 million of those. You have to remember that Ford is a company that produces close to 5 million cars a year as a whole. So setting a goal of 2 million is significant there. And then as the used car prices decline and new car prices will likely follow, we already saw it with Tesla cutting prices. You have an inventory build that's quite concerning here, and what that could mean for prices going forward. You see it here on the chart. Inventory to sales ratio is quite elevated, and that comes amidst the time where operating margins, EBIT margins, are already quite compressed here in the grand scheme of things. So if you see this continued pricing pressure, the consumer may be coming in a bit here on spending, and then you have those players still play the game of cross-subsidization in a weaker economy, then that is quite dangerous here for investors and the prospects of them continuing to get that funding for all the battery plants, but also just the design and manufacturing of these EVs, just adding that additional capacity. And then, as I spoke about in the introduction, you have a lot of global competition in this market. So will this be a transition to a winner-take-all dynamic as these cars become more technological, as software plays a larger role? Maybe there's room for consolidation in the space here. You want to be careful which ones to pick.
Yeah, you made a great point with the software. Their subscriptions grew 70% over the last year. A lot of these, I mean, as technology becomes more and more involved in these cars, there is subscriptions and there's other business models or revenue streams that are then created. That's also positive. I mean, again, like it's not all negative, but when you're looking at the base business, these business models, these car makers, they've had, it's not just this era here, it's decades of very difficulty, continuing to grow and lowering their margins, or increasing margins because of that. So it's not an easy business. And to look at here when I talk about that hockey stick move in Ford, you see the rally. I mean, in through ahead of 2022, this just a complete hockey stick move. It's come in very sharply. And one of the things I want to also highlight the GM chart, more so this has been a very technical. You get this trend lower and then a trend line supported higher. Then you break that. It's below the 382 retracement. So in a down market, you're going to stay below that 382 retracement. In an up market, the pullbacks will stay above the 382 retracement. So it's having difficulty now. I mean, you see the one big bounce back and sort of consolidating and compressing from a technical standpoint. It's also at a pivotal level that we saw, highlighted with the purple rectangle there, elongated out. It's where it spent a lot of time. So there is support that where the market's holding the right part of level, right level, but there's a lot of overhead supply and just the aftermath, the bodies that were left and sort of this liquidation. And it's going to be a tough road to get in this, to really coming out of this hole here for Ford, unless the narrative really changed, especially just given the economy where we're heading right now. These are very cyclical stocks, and who's, you're not going to see a lot of people going out there and necessarily buying new cars right now in this environment. And then the lending standards could become a little tougher too. So, let's move on though. GM here, and in the next 12 months, multiple is 5.6, right in line with the trailing. The free cash flow yield of the last 12 months remains negative. Okay, negative free cash flow yield at negative 2% compared to minus 4.9%. It's not. That's just, again, it's something here. These are having a tremendous amount of difficulty. Again, there's some positives. 40% of the I think is the EV, the GM pickups are new to GM customers. So you're expanding your customer base. That's a positive. But again, slashing revenue estimates, slashing EPS estimates, and CapEx estimates for 2023, 2024 have risen by 65% from where they were in the mid 2021s. What do you have for us on this, Jannis? But it's really the same theme I'm gathering across the board here.
Exactly. GM is really following the same theme here as Ford, as the company also engages in this cross-subsidization, as they also set these lofty goals. You spoke about the revenue estimates that have gotten slashed for General Motors here, while capital spending keeps rising by 65% compared to mid of 2021. You'll see them invest heavily in some of the battery capacity that they are trying to establish here, but trying to secure that raw material product is ultimately dependent on the success of the overall mission of them making the successful shift from internal combustion cars to electric vehicles. A lot of the same concerns really with inventories, sales, and also the potential for operating margins to compress in case prices will have to be lowered. The company does have a goal of producing 400,000 EVs by 2024. You spoke about the revenue estimates, $165 billion of revenue expected in 2023 and also 2024. They have set a target of $225 billion in sales by 2025. It seems rather elevated given where we are. So I'm not exactly sure where they're planning on getting those additional $65 billion in sales from, unless something drastically changes here.
Yeah. I mean, it's the same theme we're kind of looking at between Ford and GM. And we get to the chart to show you there's a lot of memory and price, and that's kind of what I'm highlighting here in that purple area, where this really the pre-pandemic range of GM is now where we find ourselves. Price has memory, and the similar chart to the Ford is we're below that 382 retracement now. We're also below where that dip in 2021 where it really fell off. I think that's 2020, where it really fell off. So, as it has to hold here. I mean, there's at least some trend of higher lows, and that can be constructive. But we're not really lifting much off that. So again, it's just a stagnant chart. We don't see anything attractive here. And let's finish off with Tesla. One of the themes across all of our presentations is in podcasts here, the Triple Play. You have the trailing 12 months multiple is higher than the next 12 months, and that is the situation here for Tesla, from 51 down to 46. It's not a name that we've owned. It's just not within our wheelhouse and how we expect to be investing for our clients. I've traded it personally before, but it's not an investment of ours right now, and really don't plan on it. The free cash flow has been stagnant. We talked about software, and sort of Tesla's becoming a technology company, but not only that. I mean, they've expanded out, vertically integrating with battery technology, with a joint venture with Panasonic, and these vertical integrations or multiple diversifying the revenue streams has been a theme of companies that we do want to see. And Tesla does fit in there. It's very interesting. I mean, it's going to be a company that's in the headlines for a long time to come. CapEx estimates have increased, for 2023 and 2024, but not increased like the other automakers, not like GM and Ford. So there's still an advantage here in Tesla as they sort of separate themselves as the leader in the pack. And it was something I think I think it was 60% of all U.S., 62% of all U.S. EVs in Q1 were Tesla made. I believe that was the news today. So I mean, they're certainly leader in the space. They're going to be a hard one to catch up to. Jannis, what do you have for us on Tesla?
Yeah, Tesla being the leader in the EV space, they've really made a lot of the investments that all the other core companies are still making in the midst of this more challenging environment with maybe a little bit higher rates and just investor appetite being less for risky company initiatives. So as you see here on this graph, and you spoke about that, the CapEx estimates have not nearly risen as much with Tesla as they have for GM and Ford, although those revenue and EPS estimates have also gotten slashed. You do see a little bit more stability there as Tesla has made that transition. I mean, they have not really had to make that transition to begin with because they have been an EV car manufacturer from the get-go. And that is reflected in the fact that the inventory to sales ratio has remained rather low compared to what we see with Ford and GM. That is ultimately a result of them pricing really smartly and them being able to hold inventory at levels that are not too concerning for investors. And then I think most importantly, speaking about the vertical integration and just the software products that are higher margin than the car business itself, Tesla's operating margins are looking quite promising. They have been negative for a long, long time. That was really the criticism a lot of investors had with Tesla being a cash burning machine. They're not so much of a cash burning machine anymore as they've sort of perfected the operating process and having those gigafactories, being vertically integrated and having control over all the different aspects of the business. If we do see a consolidation in the space, if this becomes more of a software type industry, then probably Tesla is going to do well here and is going to do well capturing the additional EV demand we'll see here in the years to come. But yeah, that's really my perspective on the cars. I think with a lot of these are really a lot of macro trends that are really significant here for these companies. And then with all the other companies outside of Tesla, you really have them being in this transition mode.
Yeah, I mean, the margins increasing is going to be very helpful for Tesla as it competes with these other names. That's the important thing really to take away. Where they have that foothold in the space already, they're light years really ahead of GM and Ford. So that's going to be a difference. But you know what? It's the same sort of, obviously a tremendous ascent, much more in Tesla than the other names. But more recently, we're looking at a very similar chart. It's broken out of some sort of wedge-like consolidation, but remaining below the 382. If you're a Tesla believer and you're looking to find a place to be buying the stock, obviously you want to be buying low, but you also want confirmation that we're out of the hole. And for me, the simple way of looking at it is, can we get above that 382 retracement? You also have some trend line resistance that's going to be getting to align there too. So look at the overhead price in the near term. Just there's going to be sort of just a potentially in this industry cyclically, there could be a broader headwind as well that could keep these sort of contained in the near term. But that's about what all we have here for you across the auto space. It's been a really great, interesting time putting this together. And Jannis has a great booklet for you. So check out that chart book of all the information. And thank you very much for watching us. If you have any questions or any suggestions on what you'd love to see us cover, don't hesitate to reach out, hit us up. The email address is right there on the podcast. So call us, email us. We'd love to hear from you. Thanks a lot for listening. Bill Baruch is the founder and CEO of Line Captial. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Line Captial, its staff, or its clients may maintain positions in the securities discussed in this podcast.